The first thing most people think of is a childhood memory of toys and wonder. Those memories feel warm and safe until you remember the financial hands that changed everything. Toys R Us was more than a store to millions of families who learned to shop there. That relationship between a brand and its customers is what makes this case feel like a betrayal when business decisions break it. Before the buyout, Toys R Us had a long history of being the dominant toy retailer in America. The company built a national footprint with large format stores where kids pressed their faces to display windows and parents compared prices. Retail was changing in the early 2000s, with new pressures from big box chains and online upstarts. Those shifts required heavy investment in logistics, pricing systems, and fresh store experiences to stay competitive. In 2005, a trio of private equity firms announced a leveraged buyout of Toys R Us, KKR Bain Capital, and Vornado Realty Trust led the acquisition, promising strategic change and renewed focus on growth. A leveraged buyout is a design that uses borrowed money to buy a company and transfer that debt onto the company itself. That structure can deliver big returns to buyers while making the acquired firm responsible for heavy interest payments and obligations. After the deal closed, Toys R Us found itself carrying more than $5 billion in new debt obligations. That level of leverage created fixed costs that ate into the company's ability to invest in stores and digital transformation. At the same time, the buyers and their advisors extracted more than $200 million in fees from the company they had just acquired. Those fees were paid out up front, reducing the amount of capital available for store improvements and e-commerce. Fee extraction is a common feature of many private equity deals designed to compensate buyers and advisors for the risk they take. But extracting that money from the company's balance sheet often leaves the business starved for necessary investments. With heavy debt payments and significant fee outflows, Toys R Us faced a structural problem that went deeper than competitive pressure. The company had less capital to modernize supply chains, upgrade checkout systems, or build a compelling online presence. Amazon and Walmart were increasing their investments in logistics, pricing algorithms, and online marketplaces at the same time. Those competitors were not burdened by the same debt levels and could therefore spend more aggressively on customer experience. When customers compared prices and convenience, the differences became obvious in the aisle and on the website. Shoppers started to expect instant availability and low prices, which meant Toys R Us needed investment to keep pace. Management had to prioritize debt service and meeting quarterly obligations over long-term growth initiatives. That practical reality changed boardroom debates from strategy and design to cash flow mechanics and covenant compliance. Retail staff experienced that prioritization as staffing cuts, delayed maintenance, and fewer promotions in stores. When associates were spread thin, customer service and store presentation suffered in a way that customers could clearly perceive. Inventory turns slowed as suppliers demanded faster payment, or better terms that Toys R Us could not negotiate under the debt load. Shelves began to look less attractive during peak seasons when presentation mattered most. Management and private equity owners tried various strategies to revive the business, from marketing campaigns to limited store remodels. Those efforts often failed because they were underfunded or lacked coherent investment in infrastructure and logistics. Debt covenants also limited strategic flexibility, preventing big decisions that required capital to execute properly. That lack of flexibility turned what could have been bold transformations into slow, half-executed attempts that customers noticed and rejected. By the middle of the 2010, as the strain became undeniable, with earnings squeezed and investment deferred for years, the company's financial statements showed mounting interest costs alongside weak investments into e-commerce and stores. In 2017, Toys R Us filed for bankruptcy protection, a public acknowledgement of a problem that had been growing for a decade. The filing came as a shock to many customers, but insiders had been watching the slow erosion for years. The bankruptcy process exposed how much of the company's balance sheet had been shaped by the 2005 buyout structure. Creditors negotiated for recoveries, while equity holders found their stakes essentially worthless in practical terms. Ultimately, Toys R Us announced large-scale store closures and liquidation plans that led to the end of operations in the United States. This closure was not only financial, it removed a cultural touchstone from many communities across the country. The human toll was immediate and large, with approximately 33,000 jobs lost in the United States alone. Those layoffs hit store associates, warehouse workers, and local suppliers who relied on steady retail demand. In the months that followed, private equity investors largely walked away from the wreckage with limited personal consequences. Creditors and pension funds absorbed significant losses, while equity returns evaporated under bankruptcy law. This outcome fit a pattern that critics call the private equity playbook: use leverage to amplify returns, extract fees early, and leave the company burdened and vulnerable. When the business fails, different groups of stakeholders absorb the losses in unequal ways. Defenders of private equity argue that investors take real risk and sometimes rescue struggling businesses with capital and expertise. They insist that leverage enables more disciplined management and potentially better long-term outcomes when deals succeed. But critics counter that the Toys R Us example demonstrates a structural imbalance where the upside is privatized and the downside is socialized. In this dynamic, workers, customers, and local communities bear costs that private returns cannot justify morally. There are broader lessons about corporate governance, regulation, and the social responsibilities of investors that follow from this story. If capital markets reward short-term extraction over long-term stewardship, then familiar institutions like retail chains will continue to be at risk. For consumers and policymakers, the Toys R Us case asks difficult questions about what we value in the economy. Do we prize immediate shareholder returns over stable jobs, community anchor stores, and long-term investment in national infrastructure? The philosophical twist is that brands are social contracts between companies and communities, not just line items on balance sheets. When financial incentives break those contracts, the consequences are measured in lost rituals, reduced social capital, and real human hardship. Toys R Us is a cautionary tale that shows how financial engineering can hollow out cultural institutions. When incentives are misaligned, it should encourage viewers to think differently about how capital is organized and who bears the costs when things go wrong. If this story gave you a new perspective on the reach of private equity, you are not alone in feeling unsettled and curious. The next time a beloved local brand faces takeover news, remember the people behind the shelves and the balance sheets that now control them. Thanks for watching this deep dive into how private equity changed the fate of Toys R Us forever. If this video helped you connect finance to everyday life, hit subscribe and share to keep the conversation going.